Welcome everybody to this webinar on measuring AI productivity as return, not activity. Today's webinar will be 25 minutes long approximately, with 5 minutes of questions at the end. Feel free to drop questions into the Q&A section of this webinar as we go along, and I will come back to them at the end of the presentation. A replay of this webinar will also be available on the OPTIMAZE YouTube stream, as well as at our blog on our website. I want to start with a quote because it sets up exactly what this talk is about. History doesn't repeat itself, but it often rhymes. I spent 10 years at AWS, 5 of those managing one of their largest accounts. And there's a rhyme happening right now that many of us, I believe, are repeating. So in the cloud era, we measured productivity by activity, features shipped, commits. Even the leader in cloud, AWS, was guilty of it in their reInvent keynotes. Nobody was asking the harder question, whether any of that activity actually moved the business. In the case of AWS specifically, the features launched kept rising, but the revenue growth kept shrinking. Sounds familiar? Because I think we're doing the exact same thing again with AI, except the bill is growing an order of magnitude faster this time, and it's not just technologists that are driving it either. So let's name the metrics a lot of organizations are currently leaning on. We have features shipped, commits, tokens consumed, active users, spent by user, total spend. And every single one of these tells you something that's happened. None of them tell you, however, whether it was worth it and whether it makes you money. Effort is not the same as outcome. A team can be extraordinarily active and still be losing money on every interaction, because activity metrics were never designed to tell the difference between busy and productive. The shift we need to make is from cost management to capital performance. Cost management asks, did it stick to the budget? Capital performance asks, what did the budget actually produce? Just like for the performance of your stock portfolio, we need unit economics to derive these insights. The unit economics of technology capital performance should answer 2 key questions. Did it drive growth? Did efficiency improve? Or both? What outcomes matter most depends on the organization's industry and their maturity. So let's walk through a few examples. If you're running a software business, you likely have a specific area in the business where you want to start building out your unit economics. A good place to start is gross margin delta per AI-assisted workflow. For this economic unit, you pick one workflow, look at its margin before and after AI, and whatever decision you make next is a clean efficiency win. And it's the smallest unit of proof that you can offer, because it's one feature, one number. Once that's landed, extend it to cost per conversion, driven by time to convert. If AI is genuinely speeding up qualification or response, that shows up as a lower cost per conversion. Both efficiency and growth, but now you're linking your own workflow savings to an actual customer converting, not just an internal process. From there, move to margin per customer or billing model. It needs your entire attribution model running across your whole customer base, not just one workflow, but it tells you whether one billing tier is quietly costing you more margin than another. Net revenue retention delta attributed to AI-assisted features is a more complex economic unit. This is genuinely growth-focused and not efficiency, and it's the one a sharp CFO will push back on the hardest, because proving AI specifically drove retention, and not everything else happening in the business that quarter needs a real cohort comparison and a number of different input metrics as well. But it is something that can be achieved through granular attribution and unit economic benchmarking over a period of time. A little bonus for mature customers, cost per non-converting feature. It's not proving a return, it's actually flagging capital that isn't performing. But cutting it is still a productivity and efficiency win. If you're a startup, you're likely not to have mature revenue attribution yet or necessary, and that's fine. So the unit economics you and your investors will want to set up will likely look a little bit different. Cost per validated experiment is a reasonable gateway economic unit. It's borderline activity tracking, but it at least ties spend to a decision rather than just usage. Ideally, you link it to an outcome that you're chasing, but you can also just tie it directly to runway impact. Technology cost per customer you acquire, and margin per customer once you have cemented a billing model and paying customer cohorts, will ensure your business stays healthy, even when implementing highly variable costs like AI. The question for startups is less about efficiency and whether the economics are good at a point in time. It's more whether the core economics of the business are moving in the right direction to drive growth. Being highly growth focused, implementing this without administrative overhead is very valuable for startups. At the other end of the spectrum, we have enterprise, and you'll find that many of the unit economics sit on the efficiency spectrum for enterprise. So enterprise processes like claims processing, reconciliation, compliance checks mostly sit behind the revenue line and not on it. Then there's the risk-adjusted return, which means the value produced once you Then there's the risk-adjusted return. Once you weigh it by the risk removed or introduced. For example, a fraud detection workflow might cost $50,000 a month to run, but if it stops an expected $500,000 a month in fraud losses, the risk-adjusted return is a net $450K and not just a cost. Once you attribute cost of compliance to outcomes, you'll be able to start calculating its impact on profitability. Margin per transaction processed will show you exactly how much your individual tech investments are impacting your customer transaction margins, and benchmark time to convert a customer with AI-assisted workflows to see exactly where your AI investment is helping you do more with less. So 3 things to take away from all of that. First, every measurement of performance is a ratio, never an absolute. And that's because a dollar figure on its own tells you absolutely nothing. Second, every measurement ties to a business outcome, not an activity, not usage. This also per definition means that not every cost per X is a unit economic. It often is just an attribution metric that can feed into a unit of economics. Third, and this is the one I want to sit with for a second because it's the actual definition behind the title of this talk. Productivity should be made into a ratio too. So more input for the same spend or less spend for the same output. That's it. That's the definition of productivity. Everything else in this talk is about making that ratio visible instead of guessing at it. So the obvious next question is, how do you actually calculate this unit of economics? It all starts with attribution. Every dollar needs to be attributed in at least one way, and there are 4 practical paths: by product, useful for deciding whether to keep investing in a specific feature or product. By customer, useful for knowing which customers are actually profitable once AI costs are included. By cost center, which is the organizational budget that owns the spend. And by workflow, which is different from team. A workflow is the end-to-end business process, onboarding, reconciliation, ticket resolution, that spans whoever or whatever executes each step. Most mature organizations end up needing more than one of these because a board wants the customer view and an operations leader wants the workload view, for example. However, the vast majority of organizations today just have one view and potentially some sub-dashboards of a single attribution. So let's make this concrete with a real workflow many are implementing today, which is the support, AI support. Total AI spend across the support function in this example is $600,000. This is the absolute number where most companies stop today. So the first step is to attribute that spend to the support teams. In this scenario, we will just assume that all of the spend is attributed to 2 support teams. Step 2, attribute AI spend to tickets. Step 3, add in people costs per team because AI spend alone isn't the full productivity picture. And step 4, attribute tickets closed per team, which is the outcome we are measuring. Optionally, in step 5, you could also overlay it, for example, with which model each team is using or the model mix that they're using. But I've kept that out this time for simplicity. So once you've attributed all that, you end up with a bunch of different metrics you can use to compile your unit economics. In this example, Team A costs $225 per tickets closed. Team B costs $360. The average across both is $276. That's not a vanity number. It's a controllable one because now you have immediately identified where the economics make sense. You can further inspect the metrics of the economic unit by asking why Team B costs more. Is it ticket complexity? Is it model choice? Or is it people cost? It drives a data-driven decision to double down on the AI investment strategy of Team A, which is exactly what you want. So that was a productivity efficiency output. Let's look at the profitability example where a design company, software company, wants to understand how much AI is impacting their margins of their design product for different customer cohorts. So the first step is to attribute, again, the right dimensions to get the right metrics to build the unit economics. So in this case, we have to attribute AI spend to designs and also revenue. We also need to create an attribution dimension by billing model, so we can see what customers in the different billing models are consuming in AI when they create a design. And of course, we need to attribute the revenue in this dimension as well. What you end up with is a number of different metrics that will make up our unit economics again. In this example, we have a 22% margin consumption at the top level. But once we actually dive into that absolute number, we actually see enterprise, or that total number, I should say. We actually see that enterprise customers are consuming much more AI per design generated. So this provides a solid understanding both for product, finance, and business leadership to either make price adjustments, implement limits, or double down on startup acquisition. Again, if someone wants to dive deeper and inspect what's driving these economics, going into the attribution metrics will provide you the answers quickly. And this means when cost blowouts happen, diagnosing the root issue becomes a much easier task as well. And it means that rather than optimizing the cost that shouldn't be there, you know exactly where to double down and where to cut. So those were just two examples. You can imagine in complex businesses there would be many more things that you want economics of. And with those unit economics, it stops being a claim in a slide deck and it becomes something that you can actually use to for your business. It's a business decision point telling you what products produce the best economics. It's a technology decision point telling you what to strategically invest in next. It's a team productivity signal telling you which teams and workflows have the best contribution and not the most activity. It feeds board reporting with clear, defensible views of technology investment performance. And it gives you pricing clarity, showing which pricing models or customers actually drive the best business results. So that's 5 different rooms this number needs to survive in, and it only survives in all 5 if it's built on economics, not activity metrics. An important thing to consider in all I just mentioned is that we are talking about AI in production. Dev only provides capability. You need production data to prove value. Most AI investment decisions today, the ones that get signed off by the board pack, are still being made almost entirely on development evidence. We have to remember from the cloud days that a dev environment and a production environment are not similar conditions with just a scale difference. They are structurally different, and that gap is exactly where the unit economics we just walked through either hold up or completely collapse. So here are 4 reasons why the dev metrics mislead. No real cost at scale. So dev runs a handful of queries, not the volume a live customer base generates on a Tuesday morning, and this is especially true with AI. No real data quality. Dev uses clean inputs, the messy, ambiguous, sometimes hostile inputs real customers send, especially non-deterministic. It's a completely different story, as shown in the Reddit post on the right as well, which made me giggle a little bit. No real adoption friction. A dev audience wants things to work, so there's a curated input, not customer chaos. Real customers in the wild often don't know which underlying model or chatbot they're actually talking to, and nor should they. They just want the answer. So that's the chaos production has to survive in, and dev never has to, and it massively impacts the economics of your AI investment. So here's a real-world example that we've seen firsthand with a customer where a team launched a customer support chatbot. So the customer were using it for everything and nothing. Their customers were using it for everything and nothing, and ended up burning their entire annual AI budget in a week. So the driver wasn't the engineering team using the tool harder, it was customer traffic. The feature worked, maybe not as intended, but it worked. Customer used it. Were some hostile queries, but the cost scaled with all that usage, and it consumed all of their budget. So that's not an isolated story either. So data tracked from by Ramp shows AI spend swinging a median of 58% a month from month to month across businesses, which is massive, against a near zero variance for traditional SaaS subscriptions, for example, which makes sense. Of course, we don't have this problem with these seat-based tools as they stay flat because they're capped by headcount, but customer-facing AI has no such cap. It scales with real-world traffic, and that's not something your engineering budget can control without the appropriate unit economics, like in the cloud days. So here's the ask. Before you renew or expand a piece of AI spend, demand production level cost attribution, not just the development environment numbers. and make it economics-based decision-making, not a gut call from a demo. Because the value of AI is really decided in production and not in development. And everything we've covered today, the unit economics, the attribution model, only means something once it's been tested against real business value. So let's bring it all together. We've started with the activity trap, a mistake we've made before and are at risk of repeating in the AI era. Activity metrics and how they mislead, because effort isn't the same as outcome. Unit economics prove return, and they shift depending on the stage and segment of your business. Attribution is what makes it defensible. Production, not development, is where value actually gets decided. And lastly, the ask is simple: measure production evidence before your next AI budget conversation. So everything I walked through today, attribution, unit economics, the capital performance view, only works if it's running continuously, and it doesn't have to be rebuilt by hand every quarter, because by that time, making decisions on AI might already be too late. So that's exactly what we've built OPTIMAZE to do. It automates the attribution in different attribution views that we spoke about and keeps it real time. It enables you to turn that attribution data straight into the unit economics you saw without somebody stitching together spreadsheets every month. If you want to see where your own organization sits in terms of AI economics maturity, there is a link on the screen to our maturity index, and it's a quick way to benchmark against what we've covered today and see where you stand in relation to other companies in the world. So that's the framework. Thank you very much for your time, and let's have a look at whether there are some questions, and if not, I will give it a minute for people to post their questions. Thank you very much.